Head of Global Group Communications.
Thank you, and good morning also from my side. Good morning from Wolfsburg. Welcome to the third quarter conference call of Volkswagen AG. With me today are our CEO, Herbert Diess, our CFO, Arno Antlitz, and our Head of Sales, Christian Dahlheim. And we are starting, as always, with first introductory remarks by Herbert and Arno, and then we'll hand over for a Q&A. And with that, Herbert.
Thank you, Nicole. Good morning, ladies and gentlemen. In our last quarterly call in July, we said that we would see the biggest impact of the semiconductor crisis in the third quarter. And indeed, in addition to structural effects, the one-time events from the first half, the winter storms in Texas, fire at Renaissance in Japan, significantly burdened our supplies. On top came COVID-related shutdowns at the semiconductor plants at the back ends in Malaysia. This all slowed down the strong recovery that we had seen in the first 6 months of the year. We reacted by allocating, at least to a certain extent, chips to higher margin models in order to mitigate the significant decline in deliveries across all passenger car brands. We raised prices and continued our cost-cutting efforts, and we also saw some positive effects. Our financial services division posted a record EBIT, mainly driven by higher prices for used cars. So against the backdrop of the strong first half and the countermeasures in Q3, all in all, we recorded a 20% increase in sales for the first 9 months to 187 billion euros. Our operating profit before special items stood at 14 billion euros, leading to an operating margin of 7.6%. As a result, we confirmed our margin guidance of between 6 and 7.5% for the year. We also achieved some important milestones in implementing our new auto strategy that we unveiled in July. We generated BEV record sales in Q3, which have doubled year on year. The MEB ramp-up is accelerating, especially in China. The planned acquisition of Europcar to build a leading mobility platform is progressing well and according to plan. In the first 9 months, the group delivered a total of 7 million vehicles to customers worldwide, a plus of around 7%. For all brand groups, year-to-date deliveries are still above the previous year, thanks to a very strong first half. The volume brand group increased deliveries by 3.8%. At the premium and sports groups, deliveries rose more than 13%, respectively, and the truck and bus division raised deliveries by 53%. Looking only at Q3, all passenger car brands took a serious hit due to the semiconductor supply shortage. Particularly affected were the volume brands, which with their lower margin products depend more on high volumes to drive growth. As a result, Volkswagen passenger cars, Skoda, Seat, and Volkswagen commercial vehicles posted negative EBIT in Q3. These results underscore once again the need for further productivity improvements and fixed cost reductions in the volume group in order to remain competitive. Premium and sport were also affected by the semiconductor shortage, but were able to post robust results with an EBIT of 3.9 billion euros for Audi, 275 million euros for Bentley, and 3.4 billion euros for Porsche. Truck and bus was also quite resilient with an EBIT of 453 million euros for the first 9 months. Financial services, as mentioned, posted a record EBIT of 1.5 billion euros. The regions have been affected to different degrees by the semiconductor shortage. Year to date, we gained market share, particularly in North America and Europe. In South America and Asia Pacific, the situation is more challenging. In Q3 alone, we lost some 600,000 vehicles that could not be delivered to customers compared to the second quarter. Thereof, 265,000 in Western Europe and 150,000 in China were clearly linked to the chip prices. Customer demand is high. We have more than 1 million vehicles in our order bank in Western Europe alone, thereof 180,000 electric vehicles. China was particularly hit by the lack of MQB chips from Japan, but here again, it's important to stress that decreasing deliveries are clearly a supply and not a demand issue. In the south, we will add Audi to the SAIC joint venture and will start a model offensive, particularly with highly attractive SUVs. Globally, we now expect deliveries to customers on prior year level compared with our earlier forecast, where we expected deliveries to be noticeable above prior year. Worldwide BEV deliveries more than doubled to 122,000 units in Q3. Volkswagen ID.4 and ID.3 models are our most popular BEVs. ID.3 already with more than 150,000 orders. Every second was a new customer for the Volkswagen brand. The Audi e-tron and the Skoda Enyaq are also in high demand with order backlogs above 30,000 each in Western Europe. And the Porsche Taycan has an order backlog of around 10,000. BEV share of total deliveries rose to more than 6% in Q3. Particularly in China, BEV sales accelerated significantly in Q3, with 29,000 BEVs delivered just in one quarter compared with 18,300 in the first half. BEV run rates speeding up from month to month with more than 10,000 IDs in September. Our ID city showrooms have more in-store visits, more orders, and a higher conversion rates than traditional sales channels. Currently, we have over 60 ID city showrooms in China. By the end of the year, we will expand our physical ID distribution network to around 170. We are on track to meeting our target of delivering at least 80,000 vehicles of the ID model family this year. In Europe, we have a market share of about 26% in BEV deliveries and are thus clear market leader. In the US, our market share in the BEV market is about 8%, putting us in the number 2 position. Our BEV market share is significantly higher than in the overall market. We also see continuously strong demand for PHEVs. Deliveries year to date doubled to 246,000 PHEVs. For our goal to deliver up to 1 million electrified models in 2021, BEV and PHEV, customer demand is clearly there. But due to semiconductor shortage, we might see some delays. Some of the vehicles could only be delivered next year. The successful ramp-up of our BEV strategy demonstrates that our transformation is progressing well. With our new auto strategy, we now have a clear roadmap to tackle the transformation not only to BEVs, but to a fully connected, fully digital, and vertically integrated mobile future. We have laid the foundation to tap into future profit pools with strong technology platforms leveraging our scale. Over the past few months, we have further reduced complexity by setting up strong brand groups with more responsibility. The premium group has aligned the business plans for Audi, Bentley, Lamborghini, and Ducati to lift synergies and maximize customer reach going forward. The volume group has established a governance system to foster the collaboration between Volkswagen, Volkswagen Light Commercial Vehicles, Skoda, Seat, and Cupra. And at Traton, we have replaced the complex governance structure with a lean management led by Scania CEO Christian Levin. Regarding our core technology and enabling base initiatives, we have set ourselves ambitious targets that we will report on regularly. I will now share some highlights for the technology initiatives. Arno Antlitz will later talk about one of the most important base initiatives financing the transformation. First, mechatronics. Further MEB ramp up. In the US, pre-series production started at our Chattanooga plant, preparing for the ID.4 SOP. Model will launch in Q3 22. In China, MEB production is speeding up with the ID.3 as the latest addition to the market. In Europe, our e-offensive is in full swing with the SOPs of the Cupra Born, the introduction of the ID.5 and the Enyaq Coupe. Work has started on the SSP, which is designed to provide one single architecture for our entire BEV product portfolio from entry level to top of the range. At our biggest site in Wolfsburg, the SSP will transform the platform for Trinity, our lighthouse BEV project, which will transfer the technology to the volume sector. Trinity also provides a historic chance to revolutionize the site and prepare Wolfsburg for the competition with Grünheide, including much faster production processes and more productive, a more integrated value chain, leaner and more agile management structures. The site has a real chance to become benchmark when it comes to productivity and state-of-the-art production and help the Volkswagen brand to further reduce fixed costs in Germany. Second, software. Successfully rolled out over-the-air updates for all ID customers. ID Software 2.3 offers new functions and optimizes existing ones. From now on, every 12 weeks, new customer experience. This transition has been very smooth. Third, battery and charging. Skoda announced that we will set up several thousand charging points in the Czech Republic by 2025, together with an energy company, CEZ, and the Czech government. Volkswagen Group China is building a battery system factory in Anhui, which will deliver over 150,000 battery systems a year for MEB models. SOP is scheduled for the second half of 2023. E.ON and Volkswagen have launched fast chargers with storage battery. 2 electric vehicles can be charged simultaneously with up to 150 kilowatts, plug and play. No civil engineering work is required. Fourth, mobility and services. The planned acquisition of Europcar to build a leading mobility platform is progressing well and according to plan. The proposed tender offer for the shares of Europcar Mobility Group has been filed with the French regulator AMF in September. A closing of the transaction could then take place in the first quarter of 2022. Argo AI started tests of its self-driving system with ID. Buzz AD prototypes in Munich, Germany now with one of the most progressive legislations for AD in the world. Volkswagen brand launched Auto Abo subscription model with ID.3 and ID.4, thus picking up the pace of its business model 2.0. So as you can see, while we are managing the semiconductor shortage, we are rigorously working on protecting short-term margins. We are not losing sight of the transformation of the company. We are fully committed to defending our leading position and implementing our new auto strategy. And with that, let me now hand over to Arno Antlitz.
Yeah, thank you, Herbert. Ladies and gentlemen, as Herbert said already, we are looking back on a challenging quarter. In Q3, the semiconductor shortage hit the whole industry, automotive and supply at the same time at its hardest. Also, our financial results were not spared from a significant impact. Due to a lack of chip supply, it wasn't possible for us to stick to our planned production programs. In Q3, we produced about 800,000 cars less than 2020 in the same period. Against that challenge, we clearly displayed robustness of our business so far. We achieved an operating result of 14.2 billion euros and a margin of 7.6%. Both figures almost on par with 2019, our best year in financial terms. However, looking at the third quarter alone, there was a substantial impact from the decrease in production compared to prior year's third quarter, with an effect on sales, operating result and margin. Especially in our volume brands, we also see the task we still have in terms of resilience. I will come back to this effect in more detail in a few moments. Looking at the year-to-date performance, we produced 6.1 million cars, a similar level as last year, but 1.9 million cars below 2019. Sales came in at 6.5 million cars, slightly above last year, but also substantially below 2019. Despite this drop in sales, our sales revenue came in at around 187 billion euro, on par with 2019. Here we see the impact of shift to higher priced and higher margin vehicles and the result of a very strong used car business, which is driving our sales revenue but not included in the sales figures. Cumulative operating profit before special items came in at 14.2 billion euros, significantly above last year and only a notch below 2019. This corresponds to an operating margin of 7.6%. We reported an automotive net cash flow of 7.2 billion euro for the cumulative period and a clean net cash flow of 12.4 billion euros. Whilst the premium and luxury brands performed robustly, the volume group delivered negative results in Q3 and a significant weaker cash flow. The reported net cash flow of Q3 slipped into the red at minus 3 billion euros. This was mainly driven by two factors: the consequences of the chip shortage on operating cash and the completion of the Navistar deal, which had the biggest impact on the reported net cash flow. The payment of the acquisition price of 3.1 billion euro netted against the cash balance taken from Navistar of 0.5 billion euro resulted in an overall negative cash flow impact of minus 2.6 billion euro. Net liquidity came in at 25.6 billion euro, slightly below the end of last year. However, this was a significant decrease of over 9 billion euros versus H1, mainly driven by the negative impact of the Navistar consolidation of around 6 billion euros in total. I already mentioned the minus 2.6 billion euro effect on our cash flow. Another impact was minus 3.3 billion euros related to the financial debt taken over as part of the transaction. In addition, we paid out the dividend to VW shareholders of 2.4 billion euro. All in all, we still strive for a robust full-year net liquidity of around 25 billion euro, including M&A activities. Since Q3 was a quarter far from normal, let's have a closer look into the third quarter on group level. We produced about 800,000 vehicles less than 2020 and about 1 million vehicles less versus 2019. Since we are still selling a certain amount of vehicles from stock, we proportionally lost less vehicle sales than production. We saw a shift to higher margin cars, optimized our pricing position and reduced our sales and marketing costs. These positive effects were partially offset by the very low production volume and the corresponding fixed cost effect. Although we made progress on this topic, the absolute amount of fixed cost was allocated to significantly less cars produced, leading to a significant burden on our margin. At the end of the day, we achieved a face-saving 4.9% margin before special items in Q3, significantly below our strategic target, but in light of the shortage of the chips, that was the best we could achieve. Even though the visibility of the situation still remains difficult to forecast, we see the start of stabilization of the chip supply and expected improvement of our key financials in Q4. Coming to the performance of our divisions, within the automotive division, passenger cars delivered 9.7 billion euros operating result before special items, driven by strong performance of the premium and luxury brands. This was still a solid 7.5% operating margin. Commercial vehicles came in at 0.5 billion euro. This result was burdened by substantial restructuring costs at MAN of 0.7 billion euro and the purchase price allocation amortization of around 150 million euros related to the Navistar acquisition. We expect the payback of these restructuring measures to bring positive effects in the following months. The financial services division doubled its results and contributed a very strong 4.0 billion euro result, benefiting especially from high used car demand, very good residual values, and low risk costs. Coming to our brand group performance within the volume group, Volkswagen came in with a relatively weak operating margin year-to-date of 2.9%. Within that result, Q3 isolated was negative minus 1.2%. This was mainly driven by significant loss in production due to lower availability of chips on group level, but it also highlights the structural weaknesses in terms of resilience in the Volkswagen brand. The same holds true for Seat and Volkswagen commercial vehicles. Clearly more needs to be done to improve the stability and resilience to achieve a competitive break-even point, both on brand and group level in terms of fixed cost reduction and productivity improvements. In relation to the Volkswagen brand, on the positive side, we expect North America and South America to achieve a consolidated break-even this year, despite the shortage of semiconductors. And in relation to full year, we now see a guidance for the brand of up to 3% as realistic. Skoda was also significantly negatively impacted by the chip issue. The operating margin in Q3 was negative at minus 2.4%. Due to the very solid first half of the year, the operating margin after 9 months came in at 6.8%. Within the premium group, Audi was also hit by the undersupply of chips and has lost a decent amount of sales in its core regions, Western Europe, US, and China. Year to date, the margin is at 9.6%. The margin of the third quarter was at 7%, also lower than previous quarters. Bentley maintained its rock-solid margin performance within an operating margin of 14.1%. Within that, Q3 was a very impressive 15.5% operating margin. Even Porsche was impacted by the chip shortage, however, not as much as Audi or the volume brands. The operating margin year to date is still 16%. In Q3, the operating margin was lower than the previous quarter at 11.9%. Looking at commercial vehicles in more detail, you get a mixed picture. Scania delivered an operating margin year to date of 10.7%. MAN delivered an operating margin year to date of negative 3.5%. However, this was mainly driven by restructuring costs of 0.7 billion euros. Now looking to our full year guidance. Following a very strong H1, Q3 has been a challenging quarter due to the chip shortage. Nevertheless, we have managed COVID and the semiconductor restriction reasonably well so far. We now expect full year deliveries to be on prior year level and revenues to be noticeably higher than last year. The customer demand for our excellent product is high. The order bank is filled. The combination of our strong base from H1, a weaker third quarter, combined with an expected catch-up production and sales in Q4, still gives us enough confidence to strive for the upper end of our margin guidance of 6 to 7.5%. Due to the hard hit from semiconductors in Q3, we are now striving for a level of around 15 billion euros for the clean net cash flow. Moving on to our focus on product transformation and looking at our BEV ramp-up. Our BEV volume continued to ramp up significantly. We delivered nearly 300,000 BEVs year to date, of which 170,000 were produced on the MEB platform. In the third quarter alone, we had 122,000 BEVs, of which 80,000 were on the MEB platform. Demand for BEVs is high, and we are still striving for a BEV share of between 5 and 6% in 2021 within minimal technical spending. Looking to the financing of our transformation project and looking at our fixed cost program, we managed to continue our progress and decrease this cost base by around 8% versus 2019 on par with H1. And we are absolutely committed to continue this disciplined approach, and this sharpened focus will continue into Q4 as well as 2023 and beyond. Ladies and gentlemen, we have strong brands. At the same time, we will continue to sharpen our transformation with focus on technology, ramping up battery electric vehicles and deploying and developing a leading automotive software stack. We will continue to financially steer our transformation by focusing on synergies and building resilience by working hard on cost and efficiency to be less reliant on volumes and growth. Thank you very much.
Thank you, Herbert. Thank you, Arno. It's now time for questions and answers, and we will start with the first journalist. Yes, thank you, operator. Let's start with Joe Miller from the Financial Times.
Good morning. Thank you for taking my questions. A couple of questions. The first thing is, Dr. Diess, you've always said that a car company will be among the most valuable companies in the world. Well, this week, Tesla has passed $1 trillion, and the gap between Tesla and Volkswagen is quite wide, despite having sold close to 300,000 EVs. I was wondering what you thought the inflection point would be at which that gap would start to get closed, given that the ID3 models are out there now, or the Taycan is out there now. Audi has its EVs on the streets. What's left to be done to close that gap? And a second question is just to address the drama at the moment with the supervisory board. Question that many investors will be asking is whether this is becoming a drag on your time during this transition, dealing with the various stakeholders at Volkswagen. Thank you.
Okay, Joe. Yes, I think we have received some re-evaluation as Volkswagen, and as we are being able to demonstrate that we are competitive and we can produce high margins on the EVs. I think there's still some room for a re-evaluation. We will be very successful in the EV segment. We have positive signs from all markets. Our market share in EVs in the US is already bigger than on the conventional side. China is picking up, and in Europe we are already market leader. But there is a challenge for sure from Tesla. Tesla is growing also fast, but we will keep the pace. We have introduced quite many new models over the past couple of weeks, and we will see that in the coming months. So EV sales are going to increase, and they are profitable. This is the first step. The next step is that we will be able to demonstrate that our cars are fully connected, updatable, and step-by-step able to drive more and more autonomously. And this is also being demonstrated. Now we have updated the fleet of our IDs out there with the first updates, which were well received by the customers. And every 12 weeks now, another update is prepared for launching, which will improve the capabilities of the vehicles, the user interfaces, and people will see that we will keep up the pace. Then the big transformation step for us toward this new automotive world, for sure, is the Artemis project driven by Audi, which is preparing for full autonomous driving, being launched in 25. And then this technology will be rolled out through Trinity here in Wolfsburg, by the way, for the volume segment. This is a huge chance also to transform the site of Wolfsburg for Wolfsburg to become competitive with Tesla's plans. And this is a plan which we are currently preparing together with the trade unions here in Wolfsburg. And I'm very much looking forward that we come to a shared plan, a shared vision for 2030, where this place, Wolfsburg, will be very competitive with Tesla sites in Grünheide and around the world. So this is how we are going. I think this is a shared view between supervisory board of management. So I have no doubts that we are aligned and striving for a common goal and for a shared future vision.
Thank you.
Thanks, Joe. And then the next question comes from Christoph Rauwald at Bloomberg. Hi, Christoph. Good morning.
Yes, very good morning from Frankfurt. Thanks for taking my question. I have two, please. The first one would be on fixed costs. What levers are you considering specifically to become more agile and efficient, given that there have been numerous initiatives in the past to achieve this, but the issue seems to be coming up as soon as any sort of operational difficulties occur, like the chip crisis now or the pandemic last year. So we will be able to get a bit more detail on what your plans are there going forward. The second question relates to the Chinese ventures. Your local operations seem to be under quite some pressure for the number of quarters. You mentioned they have been affected by the chip shortage to a substantial degree. Could you maybe give us an update on the roadmap there? Like what are you planning, and what initiatives are you taking to improve the resilience in the Chinese operations, given also stronger and rising domestic rivals in the country? Thank you.
Yeah. So I will take the fixed cost question. First, I must say there have been initiatives in the past, but this initiative is delivering. If you look at the figures, we compare our absolute fixed cost base, not relative, but the absolute one against a more normal year 2019, and compared to that fixed cost base, we reduced now our fixed cost by about 2 billion euros, which equals 8%, and that shows that we are very well underway to achieve our target in 2023, which basically equals 10% of a 40 billion fixed cost base, 4 billion euros in total. If you look at the levers, basically you can explain the levers if you go through the cost proportions there. We work on the indirect costs in the plants. We work on the indirect costs in the areas of sales at national sales companies. We optimize marketing spend, and the biggest lever there is more synergies in the group. We try to achieve synergies in back office operations in the groups, in the brands. For example, in national sales companies, we work together much more closer in after sales. Also, if you look at, for example, body shop construction and all these topics, the volume group, the premium group, they share components, they share development. So these are the kind of levers we are drawing. And as said before, specifically the work on synergies and marketing and fixed cost efficiency in the brands, they are delivering currently these effects, and we are positive that they will deliver even more effects in the future.
Yeah, Robert, our Chinese team for sure is under a lot of pressure because they are most hit by the semiconductor supply. Currently, most of the semiconductors they are receiving, or many are from Japan, from the Renesas plant, from Malaysia. They are really hit. We lost a lot of market share. On the other hand, there are also some positive signs. Audi is doing well, is growing, just starting with its second GV, amplifying the model lineup and so forth, so preparing for more growth. And you're absolutely right, the pressure from local startups is getting more. They're quite competent startups, meanwhile, in China, coming forward with attractive EVs, and we have to face the challenge. That is why we are ramping up our local R&D capabilities. We already have 1,000 people for CARIAD or 900 people for CARIAD working in China, and we are ramping up our R&D capabilities in Hefei, where we are having our new joint venture under own ownership. So it's challenging times, but we think that we have seen the worst, so the semiconductor supply should alleviate. The additional EVs are being launched just now, so also in China we are foreseeing a significant recovery in the coming quarters.
Thank you.
Thanks, Christoph. And then we have the next question from Christoph Steitz from Reuters. Good morning.
Good morning from Frankfurt. I would like to come back to costs, fixed costs. From your comments this morning, I'm getting the impression that what you're planning is not enough, not ambitious enough, and that that you need to be more ambitious when it comes to costs. So you have a midterm outlook that says fixed costs have to be reduced by 5% before 2023. Is that ambitious enough? Do you need to cut it more and more drastically to get where you want to go? And the second question would be on your transformation plan. Would you confirm that you can fund the transformation of the Volkswagen Group via existing cash flows, or do you need more money and more funding leeway to get it done? Thank you very much.
With the relation to your question, first and foremost, it's our target to 100% implement this fixed cost plan until 2023. As said before, that would be a 4 billion reduction versus the equivalent of 2019 and the base of 40 billion. So this is the first topic, but clearly more needs to be done in terms of productivity. we see that specifically in Q3, the resilience of specifically the volume brands is not there. So we need to increase productivity, and also we need to increase the fixed cost reduction, specifically in the volume brands and there in the production side. So there's no new fixed cost plan so far, but we really want to and need to make sure that we 100% implement that target. It will be challenging until 2023, and we need contributions on the productivity side. In terms of financing the transformation, we decided on a lot of projects there, plan program, productivity and overhead, as said, working capital, purchasing program, and last but not least, the fixed cost program we mentioned. And we are quite confident that with these initiatives and with the contributions on the product side, we are able to finance this transformation, this challenging transformation from today to more electrification and digitalization. But for that, we need to 100% implement the programs we launched so far.
Okay, thank you.
Probably that's I would make an exception on the battery side, where we don't foresee to finance the 6 battery plants and also some overseas investment entirely from our cash flows and our balance sheets. There will be some external financing there.
Okay, thank you very much.
Thank you. Thanks, Christoph. We have Jan Schwarz from Reuters as next questioner. Jan, good morning.
Yes, good morning. Just two questions from my side. One on revenue. Could you please explain what the difference is between noticeably better or higher than significantly higher? And the second one is we have this hacking attack on Eberspecher. Are they delivering any parts to Volkswagen, and what is the cost cutting the effect on Volkswagen then? Thank you.
Yeah, I will answer the more technical question. Noticeably higher is up to 10%, while significantly higher was up to 15%. So within that change in our outlook, you see also a small change in the actual outlook of our turnover. So now we expect the turnover to be up to 10% higher.
Yeah, I think you mentioned Eberspecher. I can't say. I would assume that Eberspecher probably is a supplier of us, but I can't tell you, and I'm not aware of any disturbances in our supply chain because of Eberspecher.
Thanks, Jan. Then we have Christian Hetzner from Fortune as the next questioner. Good morning.
Good morning. Many thanks. 3 questions from my side. To return to the question of market cap, I was wondering, is there an investment case you can argue for Volkswagen hitting numbers? Doesn't have to be euros, but something along those lines, or is that completely unrealistic? Secondly, on the issue of Wolfsburg, is it not unrealistic to claim that that there can be, or there doesn't need to be a major headcount reduction in order to reach your target of being competitive with Grünheide by 2030? And if not, then what is the main lever that you aim to pull? And then just as far as the chip shortage is concerned, you said that you expect the effects to ameliorate in the coming quarter, or in this quarter rather, versus I guess the 600,000 that you lost in the third quarter. Could you be a little bit more specific? Any feeling about where that number is going to be? Thank you.
Could you repeat the first part of your question, the investment case thing?
Yeah, sorry, I was just asking, is there an investment case for Volkswagen to hit a $1 trillion market cap or thereabouts?
That's big money. I think there's still a lot of upside in now if we deliver on our strategy. we should be at least now in one of the top positions in the world mobility industry. Industry is being reevaluated now, and Tesla is making the pace. So there is a lot of margin improvement and growth in our sector. It's a really big sector. It's more consolidating. Scale will be more important in the future than it is today. I'm sure that not all of the startups will make it because it's a long way to go. So I think, yes, I see clear potential in our stock, because I think we are preparing well for the next level of the playing field. I wouldn't comment. I wouldn't, let's say, I can't mention a dedicated number where we would see that potential, and it's very volatile, as you see in Tesla as well, and it seems to have a lot of headroom for us. But we see that we are in EV sales. We are in second position now already, and in Europe leading the market. It will be tight with Tesla growing relatively fast, but we're coming with many new models, many new plants. So I think we will not lose Tesla out of sight. Wolfsburg, yes, is playing a important role. I already mentioned that preparing for Trinity means preparing for direct competition with Tesla Grünheide. I think the plant is preparing now, is getting conscious that this is a new game to be played. This is much higher productivity. This is much leaner structures, but it's overall it's much more speed. Much more speed in decision making, in developing the cars, in updating the cars, and this is basically the challenge Wolfsburg has to face and has to prepare for. And we think we are on the way. Is that without headcount reduction? No, for sure we need some headcount reduction not to be as competitive. If we would assume that we would remain a big player, 500,000 vehicle plus. Then for sure, and as with higher degrees of automation, higher line speed, the direct headcount will come down, but also indirect areas with faster decision making, also reduce complexity, a lot reduce complexity. Also, indirect headcount will come down.
But let me add on that, and I want to come back to the question on the fixed cost reduction. Look, we are not about only talking about a reduction, it's more like a transformation. So we will increase competences, for example, in software, in services, in new businesses. That means that on the other hand, we need to reduce then fixed costs in other areas even more. So when we talk about absolute fixed cost reduction of 4 billion, the transformation is much higher, because we will basically become leaner. We have to become leaner on the one side, and we'll add competencies and costs on the other side. So we more or less talk about a transformation, and this, of course, is also true for Wolfsburg plant and our operations here.
Could I just actually, on that issue, my understanding was what you had said in the AGM that the 5% fixed cost reduction translated to 2 billion. How did the 4 billion come from, or where?
The 2 billion comes from base 2020, but we realized that since 2020 was basically very volatile in terms of closing, in terms of COVID. So we kept the target and we measure it against 2019, which was a more normal year, and that equivalents then to 4 billion. But the 2 billion versus 2020 and the 4 billion versus 2019 leads to the exact absolute base in 2023.
Thanks. And just on the chip shortage, any indication about where we could see volumes Q3?
Sorry, I missed out that one. I think with Q3 was for sure the quarter most hit by chip shortages, mostly also because of the one-time effects of Renesas, the plants in the US and so on, and Malaysia, then COVID, which really hit us hard now in the last weeks. I think I'm always optimistic. I mean, but we should be through the worst now, and now we will come into phases where yes, there will be some constraints because chips are. We have more demand for the technologies we are buying than there is supply. So there will be. I would say a constraint through chip manufacturing and the sites because adding capacity will take time. It's new plants. It's a shift in the technologies of the chip that will take time. So we will see some limitations because of chips also through 2022 on a much lower level. So the situation will ease, but this will be a continuous struggle and constraint for us, which we are working hard, shifting our technology towards newer manufacturing technologies, shifting through plants, redesigning chips, then also prioritizing automotive in the supply chain. We are in close contact with the manufacturing sites, with the foundries of this world, the second tier, third tier. We're getting a lot of transparency in the supply chain, and that is why I'm sure that we can stabilize the situation. But it will be a constraint because, we are adding, that's our measure, about 7% more silicon surface in every car every year, which means we need more capacity, and so the capacity has to grow faster. So it's going to remain with us, but at a much higher level, and we have to prepare for it. We have to use that also for reducing our sales incentives, for prioritizing the our mix, and making the adequate decisions. We will see some growth in 22, and that makes us also optimistic that 22 will be a much better year than 21.
Many thanks.
Thank you. Then we have Jan Schreiber from AFP. Jan.
Hi, thank you very much for taking a question. I have two short ones for Arno Antlitz and one for Dr. Diess. I was wondering if you could quantify the negative operating, operating loss for the VW brand or the volume brands in general. You gave a margin, if I recall. And then you also said you could not deliver some 600,000 vehicles, but only a part of it was directly linked to the chip crisis. I was wondering if you could elaborate on reasons for the others. And one for Dr. Diess, if I use the words of Christian Levin over at Traton, he said that the industry is in a perfect storm right now. So keeping with that metaphor, how would you describe the weather right now, and when will the sun shine bright and high again for you in Wolfsburg?
Okay, so I might start with your last question, Christian Levin. We are in a perfect storm. I think truck business is undergoing the same transition like cars. Trucks are being electrified, most of them over time, and then they're becoming autonomous. There's a lot of technology going into trucks. I think with Christian Levin now we have the right leader in place. We have the right governance model for getting the synergies between Navistar, MAN, and Scania. I think he has a very clear plan. And yes, transition you could describe as storm. How is the weather? I would say it's a lot of wind, but it's good weather. Yeah, so it's a storm. But it offers a lot of chances for us. We think we are well prepared, and actually I think we're making good progress. We have a strong ship, yeah, and we are sailing well, and we feel confident. And I think Christian Levin is probably would share that view. The other question was then the cost situation of Volkswagen brand, no?
Yeah, the Volkswagen brand in Q3 lost 180 million euros. That equals about minus 1.2% on margin. And as said, Volkswagen brand was hit pretty hard in Q3. But also, as said before, that shows that we need to increase resilience. and lower our break-even in Volkswagen brand, but also Seat and Skoda, and also Volkswagen Commercial Vehicles. Basically, as Herbert said, all volume brands slipped into the negative in Q3, and this showed that we really need to do our homework there in terms of resilience and fixed costs and productivity improvements.
For the 600,000 cars, I think maybe the ones that were not due to chips, what are the reasons in that?
It's still, I would say, semiconductors. I would say 95% is chips. We don't have, as chips are so dominant now. There would be probably some constraints if we would be close to our planned volumes, but as chips are so limiting our production, I don't see any significant others at the moment. Yeah.
Thank you.
Thank you. Then we have Max Heckler from Süddeutsche Zeitung. Good morning, Max.
Good morning. Thanks for taking my questions. Mr. Diess, we talked about common goals concerning efficiency plan, or you talked about the supervisory board. Do you think that the workers' union is also committed with a plan to reduce fixed costs? And do you think you should improve the communication? Again, we had this topic in the last years, as we experienced struggle with the Betriebsrat in the last days. And another question to this topic, you talked about the direct headcount will come down. What does that mean exactly? Is this the 30,000 number? Thanks.
Max, I think we are quite aligned. We had a supervisory board meeting where we shared the insight that we have to prepare for a new phase of competition. It's not only Tesla, but Tesla Grünheide is for us, for sure, is a new reference, setting new benchmarks when it comes to speed, productivity, also lean management, and we have to adjust ourselves to this and prepare for that competition. This competition will take ground starting 26 here in Wolfsburg when we start the Trinity project. So we have to prepare manufacturing for much reduced labor in some of the lines. We have to prepare for less complexity, for more speed, line speed, and this is what the plan is preparing for. And we agreed yesterday in supervisory board that we would prepare a common vision about 2030, how Wolfsburg would look like then to be competitive with the new entries, which is not only Tesla, there's some competition from China being expected. So with those new electric cars, which are much reduced in complexity, and where, let's say, the manufacturing time is reduced significantly. That is where we are preparing. I think we are aligned between Works Council and management, and we are working on a shared vision for 2030, on a plan to deliver the necessary change, which will be significant.
And just please let me add, what does the direct headcount, what does it mean exactly in numbers? Could you explain this, please?
That's not yet specified. No, we will work on that through the next weeks, and then we will share that vision for Wolfsburg 2030.
Thanks.
Thank you, Max. And then we have Stefan Menzel. Stefan from Handelsblatt. Good morning.
Yeah, good morning from Düsseldorf to Wolfsburg. Hello to everybody. It's almost a follow-up question to Max Heckler's question. Mr. Diess, how would you describe your personal relationship at the moment to Daniela Carlo, head of the Workers' Council?
I really highly regard her. I think she makes big difference to the work of the Works Council. She shares that vision that we need a lot of change in the coming years. And we have been talking about how we should communicate, and I agreed that I probably should participate, or I should participate in the next plenary meeting here to explain to the people what's going to happen and where we are and where we are going. So I highly regard how she's doing her job and playing her role. I think she's a really good representative for the Works Council.
Okay, thanks.
Thank you. And then last question on my list is Bill Boston from the Wall Street Journal. Good morning, Bill.
Good morning. I'm assuming that everyone can hear me. Can you hear me?
Yes, very well.
Okay, great. Thanks. Sorry, it's just a little hard to know. I have two questions. I wanted to come back to the question of valuations, and basically, it seems that the market really views Tesla and conventional automakers very differently in terms of potential growth, potential profitability, valuations. What would VW have to do to really be seen in the same league as Tesla, or is this just a division now in the way that investors are viewing these auto companies that is really never going to be bridged, that Tesla will be seen as a tech company and have different valuations, be handled by different analysts and investors than automotive companies, and the automotive companies will never really be able to make up this ground. I'd be interested in hearing more of your views about the difference in the valuation methods of the two areas. And the second question is about all of the discussion about IPOs of various parts of the company. We are now seeing, this week we have an IPO of Volvo. We've got Daimler splitting into two companies, also hoping to improve its valuation by having a pure play car company. What's your view on the IPO of Porsche, of Cariad, or the battery company? Where do you see a possibility of really improving, making the company simpler, a better investment by spinning off some of the big parts? Thank you very much.
Comprehensive question. First of all, I think the vision, the view where we are going is not too different between a Tesla and our brands. We share the view that the world will be an electric mobility world where cars will be internet devices, fully connected, updated, finally within the next decade becoming also autonomous, so the car will be a home, a workplace. It will be probably more shared than today than it is, but still there will be many private cars. So the vision is the same. The speed towards there is we are very ambitious in all the technology areas where we see the necessary change. We are investing, we are preparing. The way towards that goal has to be different. Now we are an existing car company which has to be transformed. We rely on the internal cash flows to change the company and to build up new capabilities. We have a few disadvantages, which are clearly we cannot be as focused on certain and not as vertical in some areas, but we have also some advantages because we already have scale, we have customers, we have a retail network which is working, we have an existing business where we can build up. So the two business cases are just totally different. Ours is a transformational. No, let's say you buy a existing good performing company which is preparing for the next phase, and in the case of a startup, taking away probably Tesla, because Tesla is as a startup already quite advanced. You buy some future potentials and you buy probably a little bit higher speed in one of the areas. How are the probabilities to get there? I still think that we have, within the potential investment cases, for sure the highest probabilities to get there, because we are preparing well. We're making good progress on the EV side. We are investing in our software capabilities, in autonomous driving, in the big platforms. So after Tesla, yes, we are a very good investment. Yeah. The other question was then, help me please again, IPOs. We don't see. I've mentioned already that on the battery side, we will look for some additional investors, because we are not able to finance the entire value chain for the amount of batteries we need. And trucks, you mentioned trucks. Trucks in our case is already independent. We IPO trucks already, I think it's 2 years ago now, and trucks has the right strategy now to improve its operational performance and business structure. So on the truck side, we are well on the way. Batteries, you will see some. We won't sell any of the other assets currently, because we think we are well organized now in the premium sector. This is working for us quite well now.
I think Arno Antlitz, our CFO, had one addition to a previous question.
Yeah, we had a small discussion, a small precision. Our turnover, we expect between 10 and 50% to be above last year, to be very precise.
Okay, yeah, important addition. So looking at the list, there are no additional questions at this point. Well, if you don't have any more, we are available, the whole press team and Arno and Herbert in the course of the day. And we will have the investor and analyst call in the afternoon. And then with that, I would close this call for today. Thank you from my side.
Thanks very much.
Yeah, thank you very much.
And handing over to the operator. Have a good day, everybody.
We will now take our first question from George Galliers from Goldman Sachs. Please go ahead. The line is open.
Thank you, and thank you for taking my questions. I had two questions really around software and autonomous driving. The first one is with respect to the first autonomous vehicle, the ID. Buzz. Is it correct that the autonomous systems on this vehicle are largely leveraged from Argo AI? And to the extent Argo AI goes public in the next 12 to 18 months, would Volkswagen be happy to see its ownership diluted in any potential transaction? Or would you maybe see an opportunity to increase your position and influence there? And the second one, with respect to software more broadly, your commitment to software is very clear, and I would argue very exciting. However, many investors are asking how to appraise whether Volkswagen has the technical competency in-house to develop class-leading software. What assurances, other than the scale of investment, can you give that Volkswagen will be leaders in software? And are there any near-term milestones that investors can evaluate? What is the first deliverable from CARIAD, for example? Or do investors need to wait until mid-decade for the rollout of Artemis and Trinity for validation? Thank you.
Okay, George. ID. Buzz, yes, you're right. ID. Buzz AI is driven by Argo technology. The first prototypes are now hitting German roads, where we will, let's say, test the fleet, starting in Munich, later in Hamburg, and over the next years, we will come into operations. First of all, we are happy with our investment into Argo. I think the combination between Ford and Volkswagen, we have a totally coherent set of interests. We have a minor investment from Lyft in the company, which allows us to be also closer to our customers, to the platforms. So I think we have the right investment structure, and we can afford the financing, which is still to come, and it's still a long way until we really get the investment back, but we are confident that we can self-finance together with Ford. Your question regarding software, in-house competencies and milestones. Yes, you probably underestimate that already through recent years we purchased quite exciting in-house software competencies. Now, for instance, we own in Bochum a group of 800 engineers coming from Nokia and then shifting to BlackBerry, which do the communication for our vehicles. They are state-of-the-art, very competent team. We just recently purchased from Hella a group of image recognition for autonomous driving, which is world-class, state-of-the-art. We're building up our group of hardware competencies, people joining from Intel, Apple, around the world. This is organic growth, and there will be still a few more. And we had 3 acquisitions only last year, which was wireless, which is basically how to bring software into the car, and Diconium, which is mostly based on app development. And we combined all the resources we had in Porsche, Audi, and Volkswagen into one group, which still needs accept some consolidation, because it's I think 16 different companies. We have to really find a new company identity, bring them together, and there's still a few acquisitions to do. Yeah, there are still a few acquisitions to come. But then I'm sure that we have all the competencies to have the software competence we need to continuously deploy software into the car, which is basically the reason why we are integrating that, because you then have full responsibility about what happens to the car, and you're directly facing the customer, and you have to do that in-house, because if you not do that in-house, you won't become fast enough. So this is where we are. What are the milestones? We decided that CARIAD would take over the electronics platform for our ID family, which we call Software 1.1, and is working on the next generation for Audi, Porsche, our PPE platform, which we call 1.2. So the milestones 1.1 are the currently already the updates of the cars, which are working quite well. It's the first time in volume that we update big fleets of cars, and so far it's going really well. Customers are happy. They perceive it as really an enhancement and improvement of their in-car experience. And every 12 months, those over-the-air updates will occur and show how competent we are already in performing updates and enhancing product specifications over the air. So this is going well. Next milestones for the PPE for sure are the launches. The launches are going to happen next year, and they are they are well on the way to. It's for sure it's a challenging task, but the first car will be the Porsche Macan, electric Macan. And then Audi and Porsche will deliver on this new platform their cars, which will once again demonstrate the next phase of software capabilities. And then the big step towards, let's say, really leveraging scale is then Software 2.0 being launched with Artemis and then rolled out through the whole product lineup starting in 26. This is a big challenge. This is also where most of the insourcing will happen, and then we will have full competencies, also an own autonomous driving stack, own configuration of the core operation system of the software stack. This is the full stack. Why we decided to combine, or let's say hand over all 3 software systems to CARIAD, because with each and every step and technical improvement, we are learning, we are getting better, we are training the team, and we get more focused on deploying. If we would have only started with 2.0, it would be a long way to go. A lot of theoretical tasks happening. You need the day-to-day business. And that is why we think I'm spending now more time with the career team, and actually with the recent hirings, I get a good feeling about the competencies, about what's still to do, and about the commitment and really different style of working in Cariad, which I think we are fully on the right way, and the management team is getting stronger by the week. So this is it's probably a bit lengthy answer to your question, but should be okay. George.
Thank you very much. Very comprehensive.
We will now take our next question from Patrick Hummel from UBS. Please go ahead.
Yeah, thank you. It's Patrick from UBS. Good afternoon, everybody. I would have two questions for Herbert, please. The first one is regarding your BEV execution. I mean, this year we could probably say things are going pretty well because you're doubling your BEV sales. But I know you like to benchmark yourself against Tesla. And the fact is that Tesla is growing much more than you are in absolute terms. They will grow from 500,000 cars last year to 900,000 this year. They're gapping away in terms of their gross margins. They seem to have a structurally better access to chips. They seem to have a structurally better access to batteries. So I'm just wondering how you think about that going forward. Will we just see a constantly widening gap despite your nice growth rates that you undoubtedly deliver and decent products? But what can you actually do to reverse that trend over the next 12 to 24 months? And specifically in regards to battery supply, how confident do you feel that you have enough really secured to meet probably the demand that's exceeding expectations? And my second question relates to the upcoming planning round. Can you just give us a feel what is really your priority? Is it about safeguarding the profitability over the next 5 years and we'll just get an updated 5-year investment budget? Or will you also try to pin things down to get more granular on the new auto 2030 strategy? And against that backdrop, GM a couple of weeks ago did a very precise capital markets day in terms of the growth initiatives, the business plan, the margin potential, etc. While your new auto strategy for the time being is relatively vague. So will we, with that upcoming planning round, get a little bit more granularity how you really think about your business model 10 years from now? Thank you.
Okay. Patrick, yeah, quite comprehensive questions. The gap to Tesla, we would have been closer if we wouldn't have been hit by the semiconductor supply. So we have really strong demand for our EVs. The lead times are higher than for the ICEs. We don't have to spend incentives. There's a challenge in China now where we have to probably redo our retail formats, but we have a higher share on the EV side than we have on the ICE side. So the strategy basically is working, and the effect of the strategy should increase over time because now Skoda is only coming to the market. Seat is only getting the new models being launched in China should really materialize early next year. And we have been preparing 2 sites in China. Our capacities here in Europe will increase with the additional Emden plant to come to produce electric cars. Later, Hanover in 23, and we're just starting production next year in America. So I think capacity-wise, and that's true for assembly plants and the batteries, we are ready to, let's say, stay in the game with Tesla. Yeah. So we have very competent cars. We have a much higher differentiation. We have top premium cars, sports cars, volume cars. We are strong in China, Europe, and the United States. So from there, that should really work out well, and we should achieve similar scale than Tesla. 70% of the parts of MEB are basically the same for Skoda, Audi, Volkswagen. So worldwide, later Ford will join. So that should work out well. Semiconductors really hits us stronger than Tesla. You're absolutely right. So we have less in-house competencies, and our electronics network is less consolidated than Tesla's. Now Tesla already is in the next phase of architecture. We will get there, but this will still take a little bit of time, and until then, Murat just has to make sure that we get all the semiconductors we need. He will probably report later on it, but we are, let's say, always prioritizing our EV sales. So, yeah, I think there's no. Currently, I don't see that the gap would widen further. In getting into next years, we should really be able to catch up and make some ground. Then the planning round priority clearly is get the financial figures right, enough cash flows, margins. We're strongly optimizing our R&D and also our investment budgets. So the focus is really to generate the resources to be able to further invest in the new auto strategy. You will see more, let's say, or more detailed disclosure of where we're going to invest, in which steps, how much, in the different platforms. I would say early next year. Early next year, we should be ready to talk more in detail about batteries, about the next steps in software and the SSP platform. So and then we are going also to talk more about the new profit pools and revenue pools step by step. So we will elaborate on the strategy. I think you already can see where we are going, but more detail to come early next year.
And can I just ask, Herbert,
okay?
Can I just ask, thank you for that. Can I just ask regarding the battery supply part of my first question, is there any bottleneck you would potentially see in terms of your growth next year? Because it seems things are starting to get really tight.
No, we don't see, or I hand over probably to Murat.
Yeah. Patrick, this is Murat, responsible for purchasing. So the leading shortage also next year will be semiconductors and not batteries, or not battery systems or cells.
Understood. Thank you very much.
Perfect. We'll now take our next question from Tim Rokossa from Deutsche Bank. Please go ahead.
Yeah, thank you very much for taking my questions. I'd like to add on a little bit to what Patrick just asked. And Herbert, that is really about your priorities when it comes to the planning round. And there's only so much you can do in a given day. When we look out to Stellantis, you like to benchmark yourself to Tesla, but the more traditional guys, Stellantis, they will make 10% EBIT margin this year and a harder hit on the volume side than you are. That's a number that you will probably not even achieve with Audi. So if we suggest something a little bit more controversial here, why don't you focus a little bit less on optimizing your financials? Because that seems to be very difficult for you. It's running constantly into issues with the labor unions, which is also quite annoying to some of your shareholders to read about this on an almost weekly basis. Why don't you focus more on new auto? Go really full speed ahead, try to increase your volume on that side, try to increase the quality of the vehicles, really start to roll out that issue while maintaining the margins and the free cash flow generation potential that you have today anyway. Really means focusing on one thing. You have less struggle with the unions. Why isn't that prioritization, which also seems to be more rewarded by the stock market when we look at the multiples of strong growth versus just the traditional strength of an automaker, something that you want to make your priority as well? And then secondly, and this is perhaps more for Arno and probably Christian if he's on the line as well, how shall we think about the Q4 development? Can you walk us through a couple of the bridge items? What's there with respect to raw material headwind, the volume bounce? How much will production be up? Do you already have more chips available now than you had, let's say, a month ago? Thank you.
I think we are fully focused on the new auto strategy, but and I'm focusing a lot on CARIAD, on software development. I think we spend now in the new planning round, we will spend much more than half of our investment into the new world. Arno might elaborate on that a little bit longer. So there's full focus on the new world. But even the new world requires, let's say, core competencies when it comes to manufacturing, productivity, fixed costs, because, we will maintain big part of our world. So we will maintain the plants, we will maintain our sales structures. So it's worthwhile to keep on improving the existing structure. We wouldn't invest as much anymore in, let's say, the run out of ICE engines or plants, no? But the plants we are going to use and the structures, the overheads, we have to work on, because we will need those in the new world as well. And there's also some work to do to be competitive with the kinds of Tesla. No? That is why we can't just focus on doing the new cars. And this is it. Yeah, Kim. The other question was Q4, Arno?
Yeah, Q4. I'm give a little bit of a general guidance, and then Murat is on the phone as well. He can walk us through more like on the chip side. In terms of production, we think of from a level-wise more on Q1 and 2, roughly. In terms of effects and head or tailwinds, we expect a little bit more headwind in terms of raw materials. On the other hand, our mix and pricing opportunities and also the reduction of incentives, they really come through now. And so this gives us basically confidence that we stick to our guidance of 6 to 7.5% on the upper end. So this should be more the general theme. Fixed cost work you have seen so far, we are very well underway. In terms of CapEx and R&D, we guided for 12%, with R&D due to the upfront investment into CARIAD slightly higher, but we do very well on CapEx. I mean, we spent so far almost or only 4% in CapEx, which is significantly below 20 and 19. So that should also give a little bit room on the differentiation side. So all in all, we are quite confident that we can achieve the margin to keep in a margin guidance of 6 to 7.5% with the upper end. I would hand over to Murat. Can a little bit more elaborate on the production side and supply side?
Thank you, Arno, Tim, and ladies and gentlemen. As you all know, on top to the structural shortage we have between supply and demand on the semiconductors on all industries, there were 3 events which mentioned also by Herbert, which caused the really low production in Q3. 2 of them happened in the February-March timeframe, which was the winter storm and the fire in Japan at the supplier. As this happened in the front-end process, I mean, the process takes a couple of months. It hit us in the third quarter. And on top to this, also the Delta variant of COVID in Southeast Asia, where a lot of back-end processes happen, hit also in the third quarter. This led to a very low production in the Volkswagen Group overall. Since 3 weeks, since we moved into the fourth quarter, we do week over week already an improvement. We are forecasting that we will achieve until the end of this quarter the level which we had in Q1 and Q2, where we had only in parentheses, obviously, the structural shortage. And if there's no additional event coming, we believe that over 22 we will keep this run rate in the first month, and over time we will produce probably even 5% more than we had in the Q1 and Q2 of this year. But this is a improvement month over month. We do see this already, but again, the shortfall, the structural shortfall, will be with us almost through all 22.
Thank you very much.
Okay. We'll pass over to...
Let me ask for a quick addition on the volumes. I think, as Arno has already mentioned, we expect Q4 to be clearly better than Q3.
well, not as good as Q1 and Q2 if you take the delivery numbers. Again, the full pricing effects and tactical effects that Arno Antlitz have mentioned will, of course, then be fully baked in the Q4 deliveries.
Okay, thank you, Christian. May we take the next caller, please?
We will now take our next question from Stefan Rittmann from Societe Generale. Please go ahead. Your line is open.
Good afternoon, gentlemen. Looking at your BEV progression, you've obviously mentioned the number of vehicles you've lost in the third quarter because of the semiconductor shortage. Could you make some more specific figure for what you think that 122,000 might have been if you'd had a more normalized supply of semiconductors? Secondly, looking at China, the model that Volkswagen has had has been, obviously for a long time, selling very successful European models in China. But I think the reaction to the ID family has been a bit slower than you anticipated. You mentioned some changes to the retail strategy you're planning there. Do you think there's fundamentally any difference in consumer perception and tastes for models in China that is different from that may be impacting the reception of the ID family in China? And third, you mentioned about the extension of Audi to the Southern joint venture, the SAIC, and making SUVs there. Could you give us some idea about which SUVs you're planning to make there under the Audi brand? Thank you.
Yeah, first of all, we always are China specific. No, our cars are having different interiors, different style elements, also different software functionalities for China because we have different ecosystems there which we fully adopt into it. So far, no, and after being 35 years in China, we find that there are some Chinese preferences, but many of those are really worldwide and relatively tied into the customer segments. No, so for instance, many of our cars for China are longer. They have more length because we have a better seating comfort in the back because people love to transport and have their parents in the car. So there are some preferences. When it comes to style, we also adopt. We have bigger screens in our Chinese cars. Very often, we are a bit more colorful in China, though the cars are really adopted. You're referring probably to now the new Chinese startups for the electric world, which are design-wise not so different, I would say. So we're driving those cars relatively often. Probably some of the software features have to be China-specific. No, you need karaoke functions, for instance, in the car, where we are trying to catch up with the local customer demand and learning. That is why we increased our software competencies in China. We have now, CARIAD has about 800, 900 people working in China on the ground to adopt more to the Chinese necessities. The other thing is that our ID fleet, which has quite sophisticated lane keeping and ACC functions in the car, which are really working well in Europe. They are depending on our maps in Europe, and we have different maps in China, which will take us a few months more to adopt those functions to China. So this should be specific, but we think we have all the ingredients and all the knowledge to really satisfy the Chinese customer demand. You know, if we look into the new car buyers and ID buyers, yes, they are younger. It's a different generation to come. They are probably less biased towards Western brands. Yeah, they're more open to Chinese brands. This is for us for sure a challenge. No, we are a well-established Chinese brand for over 35 years, so we have to reinvent ourselves, which is why we need new retail formats, a new sales force, new sales people there, and we are adopting. We think we can do it. You know, as we are adopting and as we are learning, sales are really picking up. The models are the Chinese models are always co-designed with our Chinese joint venture partners. So we have strong Chinese teams coming to Germany when it comes to platform design and also the interior designs. So I think we are listening to the markets, but I agree. We have to probably do even more. But there's no structural handicap we are having.
And the volume?
Audi decided some 2 years ago to have also two partner strategy in China, and is now with SAIC, with our SAIC Volkswagen joint venture. They are launching 4 new cars, which is a set of cars which is not doubling up the offerings in the north. It's really different cars, partially on Volkswagen platforms, partially on Audi platforms. I think it's an attractive set of cars, and they are testing out new retail formats. So this will be complementary and should increase our volumes and also profit pools in China. Audi is doing really well. We had a fantastic 2020 and 2021. Audi is really strongly recovering, and we think that an even wider product portfolio can really work in the south. It's SUVs based on 2 SUVs based on Volkswagen platforms, and I think it's a coupe sedan based on an Audi platform there, and an electric car based on a Volkswagen platform. So you can imagine how the cars are looking. One is B size, one is A size from the SUVs, and the electric car is an A size SUV. So it's 3 SUVs, 1 coupe sedan, I would call it.
Just on the sequential development of your BEV sales, if you hadn't had the semiconductor issues, you doubled basically from Q2 from Q1 your sales of BEVs.
There would not be any reason not to achieve those 1 million cars which we announced for the year. No, we have strong demand. We have an order bank for, I would say, on average 6 months. No, order intake, I've learned today, is close to 20% TVs now in Europe, no, which is stunningly high. It's much more than our demand. Batteries, we are fine, so it's chip shortage. Yeah.
Thank you very much.
Okay, Emma, can we take the next person on the call, please?
We will now take our next question from Horst Schneider from Bank of America. Please go ahead. Your line is open.
Yeah, thanks for taking my questions as well. It's Horst here from Bank of America. To Porsche. Herbert, I listened today to the media call, and the last comment that you made, my take was from that you denied that a Porsche IPO could happen. So therefore, given the press speculations that we had again recently, can you maybe give an update if that is the case, that you consider just this battery IPO but no Porsche IPO? Number one. Number two, looking at your bridge, Arno, it strikes me that you are not backing out any more price mix as you did in Q1 and Q2. I mean, the suspicion is then always from the outside that you want to hide something. So therefore, can you maybe clarify what was the price mix in Q3? When I back out the numbers, then I get to the conclusion that the price mix impact was rather small in Q3. And my question would be, why was that the case? And should that continue to be the case also in Q4 and going forward? Is that slowing down now? Or it's just a temporary effect that we had in Q3? Thank you.
Yeah, to your first question, Horst, you know our statement. It's we are always continuously reviewing our portfolio of brands and investments, and I can't say more about this. Second question, Arno.
Also price mix that wasn't deliberately done. As you see, the magnitude is still high. Of course, we had a slightly negative volume effect in Q3, but we can deliver the price mix effect in the future. But from the quality of the business, price mix and margin is even stronger coming through, since we are very disciplined on the incentive side. And we decided on a second price step some weeks ago, and that second price step will only come through in the fourth quarter. So you shouldn't be worried that price mix is deteriorating. It's actually the other way around, and we even promise to be more disciplined also into 2023 and beyond. So we have really stringent plans to keeping that pricing discipline throughout the planning round.
Okay, Arno, so it was positive Q3 and it gets stronger again thereafter, right? Do I get that right?
The pricing effect will get stronger in Q4 due to the pricing which comes through, Mr. Dahlheim, I think in the next month.
Maybe again, just add for explanation. Absolutely. The reason there is a lag is due to the very high order bank we have. So the cars we're delivering now are the cars that have been ordered 6 months ago. If you order a car, the cars that are delivered now have the price effect in that we priced in March. The price effect now from October, you will only see beginning of 2022, but because it takes time to deliver the cars. It's just because of the extremely high order bank we have. You have an almost 6 months delay in.
Okay. Thanks very much.
Thank you. Thanks, Horst. Thank you, Christian. Emma, can we take the next person, please?
We will now take our next question from Dorothy Cresswell from Exane. Please go ahead. The line is open.
Hi there, and thanks for taking my question. I have another one around BEVs in China. I wondered whether you could elaborate a bit on how you're finding the pricing environment for BEVs in the Chinese mass market, and also whether you've had to adjust any of your own pricing in response. And then I have another question just around magnesium and aluminium. Could you tell us whether you share some people's concerns around the risk of significant shortages as we look to 2022? Thank you.
Okay, I think Christian, in relation to pricing in China, we would pass that one to you. And Murat will follow then on the raw materials, magnesium.
The pricing in China is we didn't have to adjust our pricings through the launches, so our prices are according to the market segmentation in China, but we didn't have to adjust through the launch.
Yes, on material availability, first of all, let me say that all materials are really tight and short. It starts really with steel products, plastics, granulates, and obviously we are observing and monitoring the situation of magnesium, aluminium very closely. Until the rest of the year, the semiconductor will stay the leading shortage. We cannot forecast right now if the shortage on magnesium and aluminum, which will happen definitely according to planning, will be bigger than the semiconductor shortage. We are observing this and we are taking countermeasures already today to overcome this. So for the moment, I would say semiconductor shortage is still the leading shortage in the market. On top, probably you have seen also that additional things happening. All the transportation and logistics are tight. So if something happens in the supply chain, materials get shipped late. And also we are seeing more and more in the supply base financial stress, obviously, because of the disruptions in the supply chain. And you have seen probably also that one exhaust supplier had yesterday, 2 days ago, a cyber attack. These are all elements which are playing to the game. We are observing all of this. Bottom line, semiconductor shortage is the leading shortage.
Thank you, Dorothea. Thank you, Murat. Can we take the next person, please, in the queue?
Certainly. The next question will come from Josh Asumani from JP Morgan. Please go ahead.
Thank you very much. Afternoon, everyone. Jose from JP Morgan. I have three topics, please, for Herbert. And so the first one would be, please, what are your top three priorities when running the group? And in your discussions with the unions, do you think they have the same sense of urgency as you when you're trying to accelerate this industrial change, and specifically in Germany? Second, can you provide a bit more specific milestones on the battery ramp up across Europe? And if you could give us an update on which plants or locations have been agreed so far. And then the third topic, please. Would love to hear any comments if you give Gigacasting any merits in terms of the industrial footprint, or allowing you potentially, if you will implement it, to achieve any cost savings. And also, if I may ask, if possible, I would love to hear what was the reaction from your management team when you brought in Elon in the offsite. Thank you so much.
Interesting questions. Yeah. sense of urgency. I'm actually, we triggered a discussion here in Wolfsburg. I think it's the right time and it's coming, no? And the sense of urgency will increase because the recent achievements of Tesla are sending a clear message. No, Tesla is a competitor which we have to take seriously. And I would say also the unions see that the most sold model in Europe in September was Tesla Model 3 and not anymore the Volkswagen Golf. And the unions perceive that Grünheide is about 200 kilometers from here, a very modern plant, state-of-the-art, with high automation and probably shorter lead times in manufacturing. So I think it's the picture is getting clearer and clearer. No? And as we will launch a model here in Wolfsburg, which will be in direct competition with some Tesla models as well, it's called Trinity. No, we have to use that model and that manufacturing plant and our R&D efforts to really transform and modernize Wolfsburg and make sure that we can face and compete against Tesla. I think that idea which we basically we brought into this game 1.5 years ago when we allocated this product to Wolfsburg, now is getting into the minds of the people, and people are taking it more and more seriously, and this pressure will increase. No, once Grünheide starts its launches, you have to see that Tesla still is constrained by the supply to Europe because all cars for Europe are currently imported. Imported means it's a 10% import tax on the cars from the US and from Shanghai, basically. So the competitiveness of Tesla will increase once the launches in Grünheide happen, and we will see those cars driving around here. So I think the sense of urgency will grow. We made a case now also in supervisory board level and I think it's a shared view that we need a new vision for Wolfsburg. Converting Wolfsburg in a competitive side which can sustain competition against a very modern Grünheide side. And there are already quite good ideas. Ralf Brandstätter is working on how to not only refurbish, but I would say rebuild the plant. We already decided to do a new R&D center to stream up our R&D facilities, and we are working to streamline our overheads here in Wolfsburg. Within the next few weeks, we will work together with the union representatives on a shared vision for 2030 for Wolfsburg, and then we're going to implement that plan. So a sense of urgency, yeah, I would say I had probably earlier a stronger sense of urgency, but the Works Council is getting into the game and up to speed now that I'm confident that we can really end up with a shared view and a shared plan, because we have to change a lot here. Gigacasting, yes, we are considering now in this new architecture big casting plants. We have some facilities. Most of our casting facilities are in Kassel, so not too far away from here. Whether we would integrate really giga presses in the plants, that's not yet decided. The cost advantage is some. No, if you would do an entirely new plant and supply chain, you might consider. If you have established supply chains, it's probably not as much as an advantage as it probably looks on paper. So we are considering decision not yet made. Elon had a nice appearance in our meeting in Alpbach. You know, it depends. Some people said it was very interesting because Elon is always interesting to talk to, no, and the hidden messages between the lines. For me, it's always fascinating to talk to him. Some people may have perceived it as too detailed, as Elon is very vertical in all details. But I think everyone took the message that Tesla is very focused, very vertical, very thought through, very aggressive, very fast. And I think we took it serious. No, we took competition serious from there. I don't know. I'm looking into the faces of my colleagues. What would you say? Yeah. Generally, yes, no? It was probably a bit lengthy. We talked over an hour or so, but I enjoyed it. Yeah. Okay.
No, thanks, Herbert. Thank you very much. Thank you very much.
Thanks, Herbert. Thanks, Jose.
Thank you. We will now take our next question from Henning Cosman from HSBC. Please go ahead.
Hi, good afternoon. Thank you. I'll just ask one question about free cash flow, then maybe to Arno. It looks like the market took it a bit badly today, that the free cash flow guidance was reduced, even just with the signage. I'm kind of wondering whether that was really necessary. If you could sort of talk us through the working capital effects that you're expecting in the fourth quarter, and with a cash flow performance of 12.4 after 9 months, isn't that actually quite easy to achieve and exceed the 15 billion? Could you just share what your concerns are, why you found it necessary to make the change in the signage? Thank you.
No, that's a very good point. I mean, let's start with the overall figure. 15 billion, about 15 billion free cash flow is still, from our point of view, is a really significant number. What we see currently is that we are significantly understocked, and although we expect a better supply with chips and production in Q4, as my colleague mentioned, it might be difficult for the last cars we produce in end of November, in beginning of December, to put them through the whole line on the ships into the markets and get them out to the customers. So it's basically not an operative topic or in terms of performance that led us to that reduction. It's more like that we really see the topic that in that whole supply chain, it might be that we end up with a little bit more stock, but not more stock due to we won't like to be stock, but rather stock that is on transport. So, and this is a burden on the working capital, and this is a major effect that led us to that revised figure. Does it make sense?
So basically implying it's a fairly large negative working capital effect in Q4, right?
Yeah. And there's also a technical effect on the free cash flow, which is Navistar, but I was talking clean cash flow.
Yeah. Thank you very much.
Thank you. We will now take our next question from Philippe Houchois from Jefferies. Please go ahead. Your line is open.
Yes, good afternoon, and thank you for having me. I've got a couple of questions for Arno, if possible. Just if you can clarify, Arno, what you told us at the beginning about the net cash position at the end of the year. I heard 20, but I think it's more like 25. And the other question is more technical, but if I look at your balance sheet today on the industrial side only, there is a negative liability of 7 billion, which used to be a positive number. And my understanding of that, when it's positive, it's a loan from Volkswagen to the Finco, and it's negative, it's a reverse. It's the Finco lending money to Volkswagen. So I'm just trying to understand first, is that affecting the net liquidity you report, the 25 billion you had in Q3? And when do you think that number will go back to a positive number? In other words, when does your growth pick up sufficiently so that you grow the asset base of the Finco? If you can clarify, that'd be great. Thank you.
I'm not 100% right whether I understand your question, but I try to answer it that way. Mm-hmm. Look, the net liquidity is only automotive. It has nothing to do with FS, and we currently see, as we saw in the COVID situation, then when production is quasi shifting quite a lot, you get a balance, or you get an imbalance between payables and receivables that might affect also the net cash flow. But I'm not 100% sure whether that was the right explanation to your question. Mm. If not, what I would suggest, like perhaps you can put that question to us and we come back to you with the answer.
Okay. And for the net cash year-end, are we looking at 20 or 25?
Sorry?
The net cash, the net liquidity position for the year-end 2021 will be at least 25 billion.
25 billion, yeah. Okay. Clean cash flow 15 and net liquidity 25.
Yeah. Okay. I'll come back to you with the balance sheet question then. Thank you.
Thank you. We will now take our next question from Tom Narayan from RBC. Please go ahead. The line is open.
Hi, yes, Tom Narayan, RBC. I just have a quick one, I think, for Christian. So yesterday there was some news that I think Hertz, Tesla, and Uber were collaborating in ride sharing. The question is, to what extent is owning the scheduling app an important part of your mobility as a service aspirations? You know, certainly if all the OEMs hand over this part to Uber, this could then be hard for, you know, VW to own this part of the ride-sharing ecosystem. Thank you.
Yeah, Tom, maybe two parts of your question. First of all, of course, the delivery numbers, I want to clarify that, of course, as we said, we have a huge demand for our best, but we prefer them at this point in time to sell them to our most profitable channel, which is private customers and corporate customers, not rental car customers. So just to clarify that point. And on your second question, absolutely, we do believe you have to control what we call the layer 4, which is the customer interface, so the actual booking mechanism for different mobility offerings. And that would be also clearly our ambition with the acquisition of Europcar to become relevant in that segment, in particular, of course, in all core regions, Europe, the US, and China. So I think that's what you call the scheduling app, which is the customer-facing app.
Yeah, that's right.
Okay, Emma, may we take the next call? Thank you, Tom.
Thank you. We'll now take our next question from Arndt Engelhorst from Bernstein. Please go ahead. Your line is open.
Yes. Hi, everyone. It's Arndt Engelhorst, Bernstein. Just maybe a final question for Dr. Diess. But you do talk a lot about Tesla, and it's clear that you appreciate their achievements a lot. I just wonder, do you share the same, appreciation for other EV startups as well? Do you think they will be equally successful? If I think about the Rivians, the Neos, the XPengs of this world, there are plenty which all have very credible product, and I'd say they all ramp pretty successfully. So would you say Tesla is just the beginning, and we might see a more broad success of pure play EV companies in that market? Thank you.
And I still think that Tesla is the most relevant because it's the first one to start, and as we are a slow-moving industry, scaling is not as easy. No, it takes time and a lot of investment, and Tesla is so strong because it's 15 years of hard work and dedication and a lot of capital burned as well. No, but yes, we have to take some more of them seriously. Many will fail and have been failing already. No, because it's a different story to present a car at a show and a nice team, and the other end is really setting up a worldwide brand, being able to deliver, because our industry will remain a scale game. So you have to generate scales, but Tesla, we have to take Tesla very seriously because they are technologically good and they can provide scale, and they have also a good cost base meanwhile, and scaling is good. So it will take time, but we have to take some of the others very seriously. You mentioned XPeng, which is a car I'm driving currently. It's a very serious car, and in China already quite successful. So some of the startups will get through, but they have to first try to keep pace with us, and then probably with Tesla. So we're probably in between somewhere.
Yeah. Okay. Thank you. And if I may sneak one additional in for Arno and maybe Christian as well, how do you think more strategically and structurally about pricing? When you do your financial planning now, you've gained so much pricing. Let's say a lot of it was windfall, but how do you think about strategically internalizing some of these positive pricing trends, whether that's list prices, tactical pricing, dealer support, and so forth? How do you build that into your forecast?
I start with explaining how we build into the forecast, and hopefully then I get support from my colleague. No, what we did for the budget for next year and also for the planning round, we foresaw in the figures that there's a lasting effect on the margin and pricing effect of this year, as we promised. So we are pretty confident that that lasts at least for the next year or the next year, the next but 1 year. But it's also a chance, a structural chance for the whole industry to significantly lower the level we saw in the past, and we foresaw this in our planning.
Yeah, maybe to add to that, I mean, first of all, I think the semiconductor crisis, as painful as it is an opportunity for the industry to sort of right-size the incentive levels, which have been crazy over the last years. And we believe we have one tool in place, which is the introduction of the agency. We clearly see that already, that it significantly reduces discounts. And we think that's long-term and enables us to sort of structurally reduce 1, 2, 3 percentage points out of incentives, which, based on our revenues, of course, is huge. And secondly, we also believe that structurally people will spend more on mobility going forward, including all the software, etc. So if you take share of wallet for mobility, we believe that will increase, which all other things being equal should increase our profit pools and our profitability. And I think that's the biggest opportunity. That might not all be spent at the point of sale, but maybe some of that will be spent later. But structurally, we fundamentally believe people will spend more for mobility.
And also the effect of the ramp-up of the BEV, we currently give really minimum incentives on battery electric vehicles. And I think this is also a chance going forward. Battery will be a scarce source. So I think this is really a chance for a new level in the whole industry. And we will really play our role there.
If I may make a personal remark, my boss in particular has an extreme focus on pricing, so rest assured that that's very high on his priority list.
That's good to hear. Thank you.
Great. Thank you, Arndt. Thank you to the board members and for Christian, especially Murat, for being here today. We'd like to thank you all for your participation.